Hi, and welcome everybody to our first lecture on accounting. And we will be answering this question in this video lecture. What is accounting? Well, let's get into it then. I usually give my students this word on a whiteboard and ask them, how many words can you make from this word? The word that I'm looking for, and that's what they usually give me, is counting. So I tell them that accounting is about counting. And they ask me, what is it that we are counting? Well, we are counting 5 items, 5 things. They are assets of the business, liabilities, capital, revenue, and expenses of the business. So I tell them that accounting is about counting these 5 things. Well, some of you might take some exception to this definition and call it very superficial. I understand. So let's look at the word counting a little bit more. By counting, I mean we are recording these 5 things. So accounting would be recording these 5 things and then communicating to others the changes in these 5 items. So accounting is recording these 5 items and then communicating the changes to others in these 5 items. And we do that communication to others via financial statements. So the financial statements are 4. We have a balance sheet, an income statement, statement of owner's equity, and statement of cash flow. A public company must prepare these financial statements at least once a year, but they often prepare them more regularly so that they know how they are doing, and so that the people that we are supposed to give information to know how the business is doing. So just a quick word on who those people are to whom we prepare financial statements, or to whom we communicate this information. Well, generally they are owners of the business, investors, or potential investors, I should say, and as well as creditors of the business. So now that we know that accounting is about recording and communicating to others the changes in these 5 things via financial statements, let's talk a little more about each of these items. So asset. So what's an asset? An asset is something that is owned or controlled by a business. It must have a value. And finally, it provides benefits to the business. By benefits, we mean it helps business earn cash or save cash. So if anything has these 3 characteristics, we call that an asset. Let's take an example. If you walk into a Walmart and you see a TV there, now that TV is an asset for Walmart. Why? Because it is usually owned or controlled by Walmart. That is a valuable thing, and it will provide Walmart cash when it sells it. So that makes it an asset. Assets are of 2 types. We have current assets and non-current assets. The difference between these 2 assets is how long each provides benefits. So take a look at supplies. Supplies are things that are used in the business. They provide benefits to the business for a short period of time, which is less than a year. So we buy supplies, we use them within 1 year, and then the cycle continues of buying and using. On the other hand, land, building, equipment, and furniture are assets that the business will use for more than 1 year or beyond 1 year. So their benefits go for many years. That makes it an non-current asset. What is liability? A liability is the debts to pay. If a business has debts to pay to somebody, if it has to pay somebody, usually suppliers, that makes it their liabilities. Or if it has to pay back a bank, for example, it is a liability. Liability is also the products or services provided by the business. So for example, if you place an order on Amazon and pay Amazon, Amazon has a liability to deliver that product to you. So in a liability is not always that you have to pay somebody, but it could be also delivering products or services to you. 2 types of liabilities we have: current liabilities and non-current liabilities. Current liabilities are payable within 1 year, and if you have to pay somebody beyond 1 year, that makes it a non-current liability. Capital are the financial resources provided by the owner. Usually that is cash. And if the resources are taken back by the owner, we call it withdrawals. Revenue is money earned by selling products or services. So if you go back to the example of the TV, when Walmart sells that TV and the customer pays, now it's money that Walmart earned by selling product TV. That makes it revenue. Finally, expenses are the cost of using assets and services provided by others. So going back to the example of supplies, when we buy supplies, it's an asset. And when we use those supplies, which is we are using an asset, it becomes an expense. We call it supplies expense. Similarly, the use of non-current assets such as building, equipment, and furniture, we call that a depreciation expense. Now, expense is also when a service is being used. For example, if we use the employee's time and services or expertise, we call this salaries expense. If we use our office space, that is a rent expense, and so on and on. So that makes it an expense. Now, accounting is based on rules, and those rules tell us what all these things are. Now, what are those rules? Well, there are 3 rules. We have IFRSs. They stand for International Financial Reporting Standards. GAAP, Generally Accepted Accounting Principle, and more precisely, US GAAP, rules followed by the US companies. Companies internationally follow IFRS. And lastly, we have accounting standards for private enterprises. So if a company is a private company, there are rules developed for them known as the ASPE, and private companies can choose to use IFRS or ASPE. It depends on them. So this is what accounting is. I hope you've learned what accounting is in under 10 minutes. And don't forget to subscribe, like, and click the notification icon. And thank you for watching. Bye.